just lost a deal to Art Gilbert, and it's the same one that we just got the dock order for. I didn't know that Kevin had been working on this loan for 2 weeks. I knew he had a $1 million bridge loan in the pipeline, but I didn't know it was that one, and that Art got it. I know Art didn't know he got it from us.
No, he would have. Like you said, I kind of overheard that part. He would have said something to you. Because obviously, if you're doing the dock, you know.
All right. Probably shouldn't call it if I had known. I thought it was something important, but that's not something I could do. And actually, it's.
You take a deep breath, and
I know it's kind of upsetting. Everything. Lost a lot of deals recently.
Competition.
Yeah, I lost one to Lewis, my old agent today.
What size?
$500,000.
What were the terms that you were offering?
Oh, I don't really remember. It was coming through. It was through one of my agents. It was through Gus, so I would have had to split the deal with him. But still. But it was a good day for new inquiries today, so.
Yeah. I think, just kind of what I'm hearing out there is, you gotta, if you got so much money, you gotta get those deals done.
Yeah.
You don't want to lose them out. You don't want to do scary deals.
Right.
It's better to do deals at a little bit lower interest.
Well, this is actually a bridge loan's second purchase loan, and we were doing it at 9.2, and we lost it to 8.5. And Kevin's saying this is not an 8.5 loan. 8.5% to do a second. Yeah, I don't think George and Greg even did seconds.
What's the first?
It's a purchase of some $2 million house. I don't know.
Yeah.
I can't talk about the specifics because I don't have them in front of me, but
Use whatever mic you want.
I want the blue one.
If you do this one, only because we'll be, for that. There's nobody. In fact, I got an email, or actually I got a phone call from Rick and an email from Jeremy. I think the distance is just too much for them, so I'm gonna have to replace them with.
Well, I know Jeremy. He's really, and Rick doesn't surprise me because he barely made it the last couple of times.
Yeah.
So I need to.
And the thing is, with Jeremy, we've already got, Robert Spinoza and Robert Spinoza. It's a little bit, that one doesn't upset me. Not that it upsets me, but I just need to get somebody who's like a realtor. So I don't know if you know someone who would be interested. Otherwise, I'll just pound the pavement myself. Yeah. Okay, so you got your.
Do a couple of commercials just to kind of get my head back into it here.
Sure.
Last phone call bummed me out.
Say it angry. We're gonna get you.
This is Mark.
Yeah, exactly. Okay, what I'll do is I won't hit this yet. You just go ahead and do it, and then we'll actually no, I'll do it. Okay, ready?
This is Mark Hanf, co-host of Mortgage Investing 101. Did you know that you can earn year in and year out returns of 8% and more on your savings and retirement accounts? Mortgage-backed investment strategies such as trusted investing and mortgage pool funds can do just that. Since 2008, clients of Pacific Private Money have consistently earned high yields on their investments. Find out for yourself how you too can profit from these real estate secured investments. Call 415-883-2150 or visit our website at pacificprivatemoney.com. Who's that? I only said the number once.
That's okay. It's no, that's good. It was right around 30 seconds. So let's just.
It's definitely one. This is Mark Hanf, co-host of Mortgage Investing 101. Did you know that you can earn year in and year out returns of 8% and more on your savings and retirement accounts? Mortgage-backed investment strategies such as trusted investing and mortgage pool funds can do just that. Since 2008, clients of Pacific Private Money have consistently earned high yields on their investments. Find out for yourself how you too can profit from these real estate secured investments. Call 415-883-2150 or visit our website at pacificprivatemoney.com.
Yeah, that works. I think that actually is pretty good. I didn't worry about this. Okay.
Yeah, the 60-second one I can do without having it.
So
I should
let's
probably. they're okay with on that since we're not really saying the other radio show, so they wouldn't really know
That's
where to
yeah.
necessarily look about co-host of Mortgage Investing 101.
I think they'll be okay for. Yeah.
It's not like it's really hard to recut.
No, exactly.
I could just say co-host of the show, Mortgage Investing 101. So I'll try the 60-second one.
Okay.
This is Mark Hanf, co-host of the show Mortgage Investing 101. As a baby boomer myself, I know just how important it is to earn consistent, above-market returns on my savings and retirement accounts. Let's face it, most of us are not on track to achieve the level of retirement income we'll need to fund the lifestyle we want. High-yield alternative investment strategies like mortgage-backed investments might be just the thing you need to boost the income in your retirement accounts. Annual yields of 8% and more are not uncommon using these simple strategies. For more information about how you can participate in Northern California mortgage-backed investments, call Pacific Private Money at 415-883-2150. That's 415-883-2150. Or visit our website at pacificprivatemoney.com. You'll be glad you did.
Like 57 seconds.
Ooh, well, that's pretty good.
Yeah.
Stretch that to 60.
Yeah. Let's do it again. Oops. All right, now this time give it some boom.
Was I off on that one?
Wasn't you're off, but you're too calming. And which may be okay, but I don't know.
Let me try it with a different.
Yeah, just give it a little bit of
Different
a
tone.
boost. Yeah.
This is Mark Hanf, co-host of the show Mortgage Investing 101. As a baby boomer myself, I know just how important it is to earn consistent, above-market returns on my savings and retirement accounts. Let's face it, most of us are not on track to achieve the level of retirement income we'll need to fund the lifestyle we want. High-yield alternative investment strategies like mortgage-backed investments might be just the thing you need to boost the income in your retirement accounts. Annual yields of 8% and more are not uncommon using these simple strategies. For more information about how you can participate in Northern California mortgage-backed investments, call Pacific Private Money at 415-883-2150. That's 415-883-2150. Or visit our website at pacificprivatemoney.com.
It's 57 seconds. I think that's okay. Let's see. Yeah, he had one of them was 41 seconds, the other was 50 seconds. So, you know,
yeah, so too long and too short.
Yeah, exactly. So I think 57 seconds is fine. Okay. So
Yeah.
this one, I think that was a good one.
Yeah, that was more energy.
Yeah.
All right.
Okay.
All right. I thought I was going to do a whole itinerary, but we can So I think what I might want to do in the first segment is to again go quickly through. I had 5 points last time, and maybe I can just use 4. Just kind of, just real quickly, what exactly is mortgage investing? And I had 1. It's a way to earn 8% or more on your savings and self-directed IRA accounts. It's been called one of the best kept investment secrets by many financial experts. It's a no-fee, no-load investment that can pay you interest monthly, quarterly, or you can let it accumulate, and it's backed by real collateral. That's why it's called mortgage investing. It's backed by real estate. The 5th one I had is it's easy to invest, but it's easy to understand, but your financial planner won't recommend it. And I thought maybe we can, I thought it might be interesting to talk a little bit about, how it's growing in popularity, but there are a lot of people out there who've never heard of it. Mm-hmm. Why is that? Yeah. Well, it's because, quite frankly, your financial planner is not going to recommend it, and if you call your financial planner, your financial advisor, and ask him about trust deed investing or mortgageable funds, he's going to tell you, well, rather than doing that, if you want to invest in real estate, how about some REITs?
Where I can make a commission.
Yeah, right, because I can't make a commission on it. Do you know much about REITs? Because I actually don't. I can't talk intelligently about why they suck, but I hear from a lot of people that there's a lot of reasons not to invest in them as opposed to trust deed investing, because it's not really lending. It's not private lending. It's not really real estate investing. Isn't it more of an equity play like stocks?
Well, if it is an equity REIT, there are mortgage REITs out there.
Oh, are there?
Yeah,
okay.
But if you do an equity REIT or even a mortgage REIT, if it's traded on the stock exchange, you are subject to the whims of the stock market. It doesn't necessarily say, oh, well, it's an anomaly because it pays an interest rate. Hey, as my dad used to say, when they raid a whorehouse, everybody goes, even the ones who aren't doing anything. So I won't say that on the air, but, so, and that happens, it's like, why, wait a minute, there's nothing wrong with this, but, and so the other thing with, it is, if it gets traded, it is a little bit easier to go in and out, but it's being traded between, investors who already have it. So, interest rates go up, and for the most part, you're kind of locked. If interest rates go up, generally the prices will drop because they got the fixed amount in there, whereas an open mortgage pool, in theory, if it gets more money coming in, it gets to place it at higher yields. Conversely, the opposite is true, but mostly the idea is you're subject to stuff outside of the real estate, which is the stock market.
Right. Yeah.
So that's kind of a negative.
Yeah. I've just not heard. I know there was one time where we've done a couple of shows a while back with
Ken Wines.
Ken said, well, there's REITs out there that are returning 7-8%. There were some that he liked. Yeah. So I don't know enough about him to say, but.
By law, they have to distribute 95% of the income, but there's a whole bunch of expenses that come off the top.
Right, exactly.
So there's
no
preferential treatment. See, that's the difference. Like what you're doing is, it's like, you can't control necessarily what the interest rate is gonna be per se, but you're giving them preferential treatment. With a REIT, it's, hey, you just get what you get, and there is no, even though you're not guaranteeing the 7%, you're at least saying, listen, if there is less than 7%, there'll be this clawback, at least for a couple of quarters.
Right.
Generally, REITs don't have that kind of feature.
Yeah.
So you're really kind of showing people that you're doing more for them than what they deserve.
Okay.
Okay. So when we get into this, you want me to basically come in with Mark? Tell us what 5 points. Is it or 4 points? How did you want me to turn it over to you?
Yeah, I mean, it's not rocket science, so there's a whole bunch of ways we can do it. You just come in and say, so Mark, why don't you tell the audience what exactly is mortgage investing, and then I'll just
I would like to, without naming names, say, unlike other shows where they give you all this, mumbo jumbo,
Right.
Just keep listening and keep going.
No, yeah, I think that'd be great. I mean, I was literally listening to it on the way down here. I'm just thinking to myself, this guy said 5 minutes of nothing.
Nothing, yeah. I just, you want to just pick up your radio and throw it in
Yeah,
your
sure.
car. It's a little heavier.
It's just fill the void with junk between commercials. That's
Yeah. Okay, you ready? Here we go. Welcome. You're listening to Mortgage Investing 101. This is the show where we discuss high-yield real estate mortgage-backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co-host, Mark Hanf, broker and president of Pacific Private Money, one of the fastest-growing private mortgage investment firms in Northern California. Our goal is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields using your savings or IRA accounts. Annual yields of 8% or more are not uncommon using these strategies that we're going to discuss in today's show. And if you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. You can also call our hotline 888-529-1134 and leave your name and your question, and we'll get back to you after the show. Now, for fun, we're also going to have some trivia contests before commercial breaks, where the first 3 callers with the correct answer will win a free 3-day, 2-night vacation. And the vacations are not sponsored by the radio station, but by Lighthouse Resort Marina, located 1 hour northeast of San Francisco, and the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouseforfun.com. And today's trivia theme is geographical musical groups. You'll
easy
understand.
for you to say.
Easy for me to say, yeah, it sure is. Okay, Mark, let's get right into it. Tell our audience, what is mortgage investing?
Well, good morning, Edward. Mortgage investing, I'm just going to give you just 4 quick points on what is mortgage investing. Number 1, it is a way to earn 8% or more on your savings and retirement accounts, and it provides security and insurance for those returns. And number 2, it's been called one of the best kept investment secrets by many financial experts. Number 3, mortgage investing is a no-fee, no-load investment strategy that can pay you interest monthly, quarterly, or you can let the interest compound and accumulate. And then number 4, mortgage investing is backed by real collateral. That's why they call it mortgage investing. It's backed by real estate, and in our case, Bay Area real estate. And just for the heck of it, I'll throw in a 5th point. It's fairly easy to understand. It's a very simple type of investment, but your financial planner won't recommend it to you. And we'll talk a little bit more about why that is.
All right, let's start off with the first point. What's the first point again?
Well, it's a great way to earn 8% or more using your savings or IRA accounts. And
okay, so the first thing I think of, I hear 8%, and today's interest rate environment, 8% seems kind of high, especially when the bank is paying 0.000001%.
Well, and I get calls almost every day from a new prospective investor. We have this show. I run newspaper ads. I speak publicly. I get referrals from other clients, and
we also have the other radio show.
Yeah, it's the other radio show, which is The Best of Investing on our sister station, KKSF 910, which will be playing at 1 o'clock later today, 1 o'clock Saturdays. So I get calls from people going, it sounds too good to be true. What's the catch? And quite frankly, I think one of the reasons why mortgage investing is gaining in popularity is because there really is no catch. It is so much better, in my opinion, in many ways, than CDs, bonds, and in my opinion, stocks.
Sure.
Again, I'll admit I'm not a big stock guy. I've never done really well in the stock market. I've been my family, and I come from generations of real estate investors and builders and contractors, and personally, I'm a real estate investor, and I've always believed in the real estate market. And of course, we just went through this big adjustment, obviously, in 2008. But be that as it may, these mortgage-backed investments in the forms of also known as trust deeds or mortgage pool funds, they're all secured by real estate that is largely adjusted in value. And unless you believe the real estate market is going to tank considerably again, we're in a situation where the loans that back these investments are generally no more than 65 to 70% of today's market value of the real estate. So there's a lot of protective equity, they call it, and that collateral is fairly strong. We're talking about first position loans. When you do mortgage investing, whether it's in the form of trustee investing or you invest in a mortgage pool fund, by and large, most of the loans that are being funded today through these resources are first position loans on local Northern California real estate.
Well, it sounds like you're the bank, and the banks are making a lot of money right now because they are lending money out at fairly high rates compared to what it costs them.
Well, it is, and so mortgage investing is known by a lot of different names. I mentioned trust deed investing. I mentioned mortgage pool funds. It's also called private lending because when you participate in a mortgage investment, you are in fact being the bank. So whether you're aware of it or not out there, Mr. Listener, the banks today are making mostly consumer home loans. That's really the loans that you hear about every day on the radio with rates at, now it's 4.5%. But consumer home loans is the vast majority of the loan market. And banks today, that's really the only loans they do. They are not making loans to real estate investors. Well, why is that important and why should you care? Well, why you should care is because since 2008, a huge market has opened up, and we all know the market abhors a vacuum, and that's, capitalism came forward, and the whole private lending industry has really grown, and as a result of the fact that the banks really stopped making loans to real estate investors, and yet the real estate investment industry is a huge part of our economy. I mean, some think that real estate accounts for a majority of the gross national product because it creates jobs, and you're talking high dollar amounts, particularly here in the Bay Area. So when you participate in mortgage investing, you are the lender. You're participating in loans that are in high demand, and they're usually short-term loans. They're short-term in nature because real estate investors generally only want to use that money for a short period of time, maybe 6, 8, 12 months, and they're willing to pay high rates of interest for it. Why? Well, because they can't get it anywhere else cheaper. That's why. And so the market for a private money loan for either purchasing real estate or cash out on existing real estate today, the market rates are anywhere from 8 to 12%, generally falling maybe within a 9 to 11% range. And when you participate as a private individual funding those loans, you usually get something right around the note rate minus, say, 1%. Because most of us in this business, we service the loans we originate, and when we use private capital, we usually pay, if it's a 10% note rate, the investor will get 9. If it's a 9% note rate, the private lender or investor will get 8. So that's why we say 8% or more, because that's about the average return you can expect. So, we could have done this show and start talking about 10% returns, because I have some investors who get 10% returns. They're willing to take a little bit more risk and loan slightly higher amounts.
Like instead of 60% loan to value, maybe it's 70%?
Maybe it's 70%, maybe it's 75%, maybe it's in certain neighborhoods of the Bay Area where the property values might have fallen more dramatically, and they may be considered a little riskier. There may be neighborhoods where you and I might not want to live, but there's certainly a demand for housing, and so you can usually charge more for a loan to a real estate investor fixing and flipping in that market.
The thing that I think is kind of funny here is that with certain FHA loans or whatever, you can still buy a house for, let's say, 5% down.
Yeah.
So the bank is lending 95% loan to value. Now, it is somebody's personal residence. So maybe the theory is the person's more likely to pay off or pay the loan on that rather than some investment property. Because if you're not lending on personal residences, you're lending to people who are real estate investors mostly.
Yes. Mm-hmm.
Okay. But the issue that I would look at is if you've got somebody who is putting down 30%, so if you're lending them the other 70%, they got a lot of skin in the game. They're less likely to walk away. Isn't that usually the case?
No, that's absolutely true. So you hit it on the head. So we're not making consumer home loans. This is not a primary residence loan, but we're also not making loans to guys who are putting 5% down, or even just 20% down. I mean, 30% down plus closing costs. So you figure most of the guys we make loans to, they have to come in with about 35% total to close. 30% down plus around 5% for closing costs and fees, et cetera. So this is not. This is not a beginner's game. These are people who are experienced, generally are successful real estate investors, and they have capital, or they've got partners with capital. We don't generally care where the money comes from as long as it's going into the property.
And are you finding that the banks just aren't making those kinds of loans at all, or are they just very stringent?
They're extremely stringent. So there are people who are borrowing from the banks for their real estate investment portfolio, but generally these are people who have substantial amounts of cash in the bank. They have super high credit scores, and it's like the old adage: in order to borrow the money, they have to prove they don't need it.
Well, and that's funny because I'm just recently doing that now with even just my home loan, and the bank is telling me, we'll get you this great rate if you can show you've got $1 million in deposits.
Right.
But if I had $1 million deposits, I wouldn't need you.
Well, and then lastly, it's the speed function. So you've heard that the real estate market is really hot right now in the Bay Area. So inventory is low, prices have been increasing, and a lot of people who are trying to buy property, and this includes real estate investors, are finding that they are being outbid by all cash, no contingency offers, close in 10 days. So as a hard money lender, I need to be able to react to that need. So we can close a loan in 5 business days.
That's amazing.
There
Close
isn't
that fast.
Right, there isn't a bank around that's going to close in less than
30 days.
Well, I hear 21-day closings, but
yeah,
that's,
but it takes a while just to get the appraisal.
right, exactly.
Yeah.
So even
I tell you what, hold on to that thought.
Yep.
One of the things I really appreciate about this show compared to other shows, we talked about this before we went on the air. So many other shows don't really give you much information. There's all this mumbo jumbo, and then you got to call this phone number, and then you got to attend this seminar and buy all these books and blah blah blah. This show, Mortgage Investing 101, is designed to really get into the nuts and bolts and educate the public. Which, in fact, this is our 3rd show now. And we've had emails already from listeners saying we really appreciate the fact that you guys are giving us real information. Okay, so we're going to cut to the first commercial break, and here's our trivia question. The theme again is geographic musical groups. Which rock band produced hits such as Long Time and More Than a Feeling? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. Which rock band produced hits such as Long Time and More Than a Feeling? 888-529-1134. In fact, if you sang it, Mark, they would probably know the answer.
maybe for the answer.
Maybe for the answer, okay. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial because Mortgage Investing 101 will be right back.
Excellent.
I figure it's good sometimes for me to feed you.
Oh yeah, please do.
Yeah.
No, it's more. I know that I can. I'm trying to become more aware of being less long-winded, but it's hard.
Yeah, because there's a million things to talk about all the time.
And if I'm not careful, I can start talking about one thing and go into another.
Do I know that well? Because there's just so much to do. Okay, so
we talked mostly about the too good to be true. We can kind of get back to that too good to be true. It's not too good to be true. I'd like to actually, let's go back to, because I've got a couple of statements I can make about that. Like, people right now are doing this. In fact, a lot of guys that I know who've been doing this for 20 years are upset that so many new people are coming into the market.
Yeah,
They
that
had
is
it all to
absolutely
themselves.
True. Yes.
You know, this used to be the realm of sophisticated real estate professionals like brokers and other real estate.
So all it does is do
It's
competition.
it was one of the best kept secrets in investment strategies.
Sure.
So we're trying to hit about 15 per segment.
Roughly,
Okay, good.
roughly 15.
All right, good.
Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with my co-host Mark Hahn, president and broker of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. When we cut to the first commercial break, we asked this trivia question: which rock band produced hits such as Long Time and More Than a Feeling? Mark, sing it for us.
More than a feeling.
There you go. Which group would that be?
Boston.
Boston, that is correct.
Never claimed to be a budding rock star here.
That's why you're in real estate instead. Okay, Mark, you were giving us some pointers. One of the things was that, mortgage investing, too good to be true. Why don't you continue?
Right. We get that a lot. So we talked a little bit last segment about how many people feel when they hear, returns of 8%, or certainly if you start hearing double-digit returns of 10%, you figure it's got to be risky. It's too good to be true. Well, it's not too good to be true. It is true, and quite frankly, people are investing in trust deeds and mortgage pool funds and making 8% more on their savings right now. And in fact, one of the points I brought up at the beginning of the show, that it's been called one of the best kept investment secrets. And in fact, people that some of my best clients who've been doing this type of investing for over 20 years and have huge portfolios of mortgage-backed investments, a lot of them are upset right now that it's gaining in popularity, because they knew that they were the only game in town. And in fact, 10 years ago, it wasn't uncommon for them to get 12 and 13% on their money by lending it privately on Bay Area real estate. Now, so actually the rates have come down. So 8% is actually low, believe it or not, for private lending. And in fact, depending on other parts of the country you go to, there are parts in the areas of the United States where if you participate in private lending, you will easily see double-digit returns.
Yeah. Well, it reminds me, for the audience out there who may still are not that familiar with mortgage investing, it's almost like when you find a super good babysitter, and you really don't want to tell anybody, because once you do, suddenly when you want that babysitter, she's not available. So it's very, very similar to that. So when you say, okay, it's not too good to be true, let's talk about the risks.
Okay.
All right.
Well, I mentioned at the beginning that there are elements of security and insurance on here. Let me explain that, because when we say secured and insured for mortgage investing, sometimes I'll get a call and someone will ask me on the other end of the line, they'll say, is it insured by the government?
Yeah,
is it FDI insured?
Yeah.
And in fact, the answer is no, but I think it's better than FDIC insurance. I think it's funny. I mean, I literally talked to a gentleman today, and I asked him, why do you think FDIC insurance is better than the insurance that this particular investment offers? I mean, have you ever made a claim to FDIC? I mean, if a bank fails, how do you know it's not going to take a year to get your money back?
Well, in fact, there have been situations, I remember hearing this in Ohio, where someone had $100,000. So they were completely insured, but because the bank was in such disarray, the government came in and they said, okay, don't worry, it's FDIC insured. However, no matter how much money you have in, we're only going to allow you to take out $250 a month until we can figure out the books.
Well, that's just it. So when we talk about insurance and how these investments are insured, here's exactly what we mean. There's two types of insurance related to private lending or mortgage investing, and they are the hazard insurance that covers the collateral, the home, so that if it burns down, the mortgage on the property gets paid first, okay, before the owner of the property. And then number two, there's a title insurance policy, a lender's policy of title insurance that ensures that your lien, the mortgage on the property, is in first position, so that there's nobody ahead of you. There's no mortgage, or there's no mechanics liens. You're not accidentally investing in a second when you thought you had a first. So you have the title insurance policy and you have the hazard insurance, and those together provide a strong insurance to protect your collateral and to protect your principal investment. Because at the end of the day, it's the security that really matters, right? I mean, you've got collateral, you've got real estate, Bay Area real estate, and then you've got the insurance. So it's again, in many respects, it has features that you're not going to find in other types of investments. I mean, let's talk about the stock market. That's where most people are riding on for their future and for significant growth in their investment portfolio. I mean, other than stocks, where else are people investing, hoping for a windfall?
Well, actually, that's kind of interesting you mentioned stocks, and I've done well in the stock market. I've lost money in the stock market, and my stomach now can't really handle the ups and downs. But when a company is worth, let's say IBM, is worth X amount of dollars, when you invest, you're just buying stock from someone else who previously owned it. And how many companies are sold for under the book value?
Right.
Not much. I mean, usually it's 10 times book, 20 times book. And in this case, when someone invests $70,000 on a $100,000 property, they're actually investing under the book value. You understand what I mean?
Absolutely.
So you've got some protection where if the value of the property drops, which again, if the borrower is still paying you, it almost doesn't matter. It's only if you had to foreclose, then you would say, okay, well, where's my risk?
So before this year, when we've had a pretty decent run up in the stock market, I mean, if you went back in the previous 10 years, I mean, we saw some of the lowest annual returns of the indexes and of the major stock portfolio funds, and yet had you been investing in well-secured conservative mortgages, you could have seen returns of let's just say 8% annualized on an annual basis. Compare that to I think in many indexes we're up less than 10% over a 10-year period.
Sure.
So
and if you had been investing in like one of the funds that you were talking about where you could reinvest, then after 9 years, your money would double if you're getting 8% on your money.
Right, exactly. And keep in mind too, we're talking about a no-load investment, whether you invest in an individual note, also known as trustee investing, or if you invest in a mortgage pool fund. These are no-load, no-fee investments. If you invest $100,000, all of that money goes to work. 100% of it goes to work.
Is that why my financial advisor is not going to recommend it?
Well, your financial advisor is not going to invest. It's not going to recommend this because they can't earn a commission on it. I mean, I know that there are financial advisors out there that some are fee-based and some are based on assets under management. There's a lot of ways that your financial planner might be paid. But generally speaking, they're not going to recommend non-publicly traded or non-commissionable types of investments. Well,
here's one of the interesting things I was thinking is that not too many fee-only planners are going to recommend it because it's a fairly passive investment. If someone invests in one of your mortgages, let's say, or mortgage funds, and it's, let's say, a 3-year, like give an example, a 3-year loan, then nothing's going to be done with that investment for 3 years. It's like buying a 3-year CD. Well, can you imagine the financial advisor charging an annual fee every year based on the assets under management? I mean, they're going to lose some clients potentially because
Absolutely.
They're not really doing anything for that fee on those kinds of assets. So I can see why financial advisors would be very reluctant to advise this.
Right. In fact, and if you call your financial planner and ask him about, so what do you think about investing in trust deeds or mortgage pool funds? After they tell you how you'd be crazy to do that, they'll say, well, if you want to invest in something that's backed by real estate, how about a nice real estate investment trust, or REITs, R-E-I-T as they're known. And that, again, is not what we're talking about here. We're not talking about REITs, which are like stocks, publicly traded. In fact, Edward, you're fairly familiar with REITs. I mean, they're.
Oh yeah.
How do you think they compare to something like a fixed rate of return mortgage-backed note investment?
Well, hey, let's put it this way. The Department of Justice appointed me to chair the equity committee of a $500 million REIT back in 1993 because it went bankrupt. Well, why did it go bankrupt? Well, they borrowed money. And so, it's the problem with a publicly traded REIT is the fact that it's still part of the stock market. So even if all the assets are fine, the problem is that when the stock market drops, a lot of times, not all the time, but a lot of times the REITs will drop. And so you're looking and saying, well, wait a minute, my principal is fluctuating. I don't want that. And the nice thing about an individual deed of trust is it doesn't fluctuate. And in fact, in some mortgage pools, which Pacific Private Money is starting this mortgage pool, the principal's pretty fixed, isn't it?
Mm-hmm.
Yeah.
Absolutely.
So it's kind of nice when you don't have to worry about looking in the paper every day and wondering if your investment's still worth the same principal amount.
So let's talk for a moment about the types of loans we're actually making. We talked earlier that we are competing in an area of finance that the banks largely pulled out of in 2008, and that is loans to real estate investors. So, and I think I mentioned that we oftentimes, I think one of the loans we make the most are to folks who are buying, fixing, and flipping property. And when people hear the word flip, particularly people who aren't really familiar with or don't know what we're talking about, we're not talking about the type of flipping that got a bad name in early 2000s, where people would just buy a property, slap some paint on it, and sell it for $50,000 or $100,000 profit. That's not happening in the market right now. What's happening is that there are real estate professionals who are buying distressed homes that haven't been remodeled in a while, or maybe they were foreclosed upon and might have gotten, trashed a little bit on the way as the owners left. And they're buying these homes, and some of the remodels are actually fairly substantial. I mean, if you're talking about, like, for example, the city of Oakland has thousands and thousands of homes that were built in the 1940s and 50s, and many of those homes can be purchased today and have not been remodeled at all in all those years. And I've got investors that are going in, buying these homes, doing literally a gut remodel.
Okay, and they're not necessarily in bad parts of Oakland.
No. Well, again, there are wonderful neighborhoods throughout Oakland that are highly desirable and are sought after by entry level home buyers and new home buyers. And so they'll go and they'll do a gut remodel, which means they'll literally take the house down to the studs on the inside, not the outside. The outside may be stucco or wood siding,
sure.
And they'll usually repaint and repair the outside, but the inside they'll go all the way to oftentimes new plumbing, new wiring, new sheetrock. Maybe they'll refurnish the floors that they found on the hardwood floors, the original hardwood floors that were under the carpets.
Oh, yeah.
And they'll put in new bathrooms and new kitchens. So you've got a turnkey like new home that are in well-established neighborhoods. And those properties are in high demand. I mean, I work with a lot of repeat borrower clients who love to come to Pacific Private Money to borrow money because we're fast and we understand what it is they do. We know and understand real estate investors and rehabbers and contractors. We speak their language. I've been in business for 30 years. So,
which reminds me, it's been a while since we told people that they're listening to Mortgage Investing 101.
Yes, indeed.
And I'm Edward Brown, and my co-host here, Mark Hanf, is president of Pacific Private Money. Mark, one more time, give out your information, because I know we've heard this before, where people are really interested in what they're hearing on the radio, and they say, well, you didn't tell me long enough.
How do I get a hold of
you guys?
Right, so our website is pacificprivatemoney.com, pacificprivatemoney.com. We actually have two websites, but you'll see a link on the pacificprivatemoney.com website that'll take you to Pacific Private Investments, which talks a little bit more about the investing side, because the primary website does talk a lot about the borrowing side. You can certainly call our office. We're here in the Bay Area, 415-883-2150. That's 415-883-2150. On the weekends, of course, we're not in the office, but please leave a message and we'll return the call promptly, or you can send an email to us from our website. We're working on our new Mortgage Investing 101 website, so in a future show we'll talk a little bit more about that. But absolutely, it's important that you give us a call and let us send you some information.
Okay. And we're going to cut to our second commercial break here. When we come back, I think it'd be kind of fun to get into specific examples, because
Indeed.
We're talking in theory, and it'd be really nice, I think, for the audience to hear exact examples that they can understand a little bit better.
Yes.
Okay, the theme is geographic musical groups. Here's our second trivia question. Which rock band produced such hits as Wishing You Were Here and If You Leave Me Now? And again, if you sing it, it's going to be a little easier to remember. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 529-1134 to answer this question. Which rock band produced such hits as Wishing You Were Here and If You Leave Me Now? I had to do that one. Okay. Call 888-529-1134. Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time. Don't touch that dial, because when we come back to Mortgage Investing 101, we're going to be getting into exact examples as to how investors are getting 8% and more.
By the way, that was one of their gayer songs.
If You Leave Me Now?
Yeah. Chicago had a lot of good hits.
Wishing you reminds me of good times going to Stinson Beach.
Yep.
So on our mortgage on Sports Econ 101, guess who's going to be our guest in a couple of weeks?
Coach.
No. Buddy Biancalana. Remember he played for Redwood and then he went to the Kansas City Royals?
Oh, yeah.
Yeah, baseball player.
That's right. Kevin made a loan to Dave Fiore, who's working on it right now. Former 49er.
Oh. Well, you know what's funny? I had my banker, Jamie Williams, from Wells Fargo. Actually, it was Greater Bay at the time. And he said, "Because Edward, Jamie Williams. Hey, Jamie, how you doing? Because I want to introduce you to Jamie Williams." I go, "Wait a minute." I go, "The only other Jamie Williams I know is a tight end for the 49ers.
Yeah.
He goes, "Yeah, come on over, meet him, and we'll talk business." And, he wanted a loan from us, but he's a smart guy, but he just didn't have all his ducks lined up in a row yet.
There was one of the famous historic 49er figures. Y.A. Tittle.
Yeah.
When I was working for Pacific Private Money, who ended up being an asshole, Vince Tamara. Yeah, we got a call from Y.A. Tittle, who was trying to borrow money. He was an insurance agent. I think he's
Yeah,
passed
it was
away.
insurance.
Yeah, he was
Yeah.
insurance.
Yeah.
He was trying to do a hard money loan. We couldn't do it for me, but it was just so clear that he was trying to bank off his name. You know, I know
MC
the one-
Hammer did
yeah.
that with us too, and it's like, sorry. Yeah.
I can't do that dance, but
Yeah.
the fast dance.
All right, so let me see how much we got here. We got some time. All right. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, broker and president of Pacific Private Money. And when we cut to the second commercial break, we asked this trivia question. Which rock band produced hits such as Wishing You Were Here and If You Leave Me Now?
Well, those two songs you used as examples, I think some might argue about it being actually rock, but
Yeah, well, that's true.
that'd be Chicago.
Chicago, that is correct. Okay, Mark, the audience, we told the audience when we left for commercial break that when we came back, we were going to get into exact examples as to what you're working on.
So we're talking about mortgage investing, where you can earn 8% or more on your savings and your self-directed IRA accounts, also known as trust deed investing, mortgage pool fund investing, private lending. It goes by a lot of different names, but it's essentially we came up with the show Mortgage Investing as kind of a catch-all to talk about these alternative types of investment strategies where you're providing the funds for real estate secured loans, mostly to real estate investors. So let's talk a little bit about types of loans, real world types of loans that we're doing every day, and we're doing anywhere from 15 to 20 loans per month on average out of our small office, Pacific Private Money, based here in the Bay Area. And so actually I want to tell you about one example in particular. Now, we did say that we make loans to real estate investors and we don't do consumer home loans. Now, that's not 100% true because there is a type of consumer home loan that oftentimes we're called in for help. And I'll give you an example. So there was this young family who was having a new home built for them in the East Bay. And they went into contract back in November. And here it is, well, now we're in August, but this was back in June. I get a phone call from the applicant who told me that they were approved for their purchase money loan from a bank to buy the home once it was done. But an unexpected credit glitch came up on their credit report, and they fell out of bank financing. So,
can you give without obviously giving names and stuff, what kind of glitch happened?
well, this fella had worked overseas for a couple of years in Germany, and he paid his taxes as required. But apparently, something happened, and the IRS didn't believe that he had made a payment when he did, and he had proved it and sent it to them. Well, unbeknownst to him, they went and filed a tax lien for like some amount of money, and it wasn't true. So he had to prove that he didn't owe it. But you know how the IRS works: is they shoot first and ask questions later. So
Sure. So it still showed up in his credit report.
it still showed up in his credit report,
and he
the
couldn't
bank-
explain that away to the
right,
bank.
and the bank denied it. So this family had $50,000 hard on deposit with this new home.
Meaning that it was non-refundable.
It was non-refundable, and if they didn't close that loan in the coming couple of weeks, the developer was going to sell it to a family and sell it for more money than this family had already contracted to pay for it, because the prices had gone up in those 6 months.
Okay, so the developer actually was hoping that the deal was not going to happen because he could sell it for more.
Right, he was going to get another $150,000 on the price, because we were talking about $1 million home.
Wow.
And the prices had gone up 15%.
Okay, so in this example, you actually have a regular old borrower, a bank borrowing type client who really theoretically didn't need you. They could have gone to the bank, which they did. But because of some small, weird situation, in this case a glitch on the report, that really had nothing to do with them because it was not correct, suddenly now they're put in a position where they're not really bankable, or at least in time. You know, maybe if they give them another 6 months, the IRS would have gotten the credit taken care of, but they didn't have that kind of time.
No, they didn't have the time,
So
and they needed to close. And so while they were not thrilled with going to a hard money lender and paying a high rate of interest and paying the points and fees that are associated with a hard money loan, the cost of losing that home was greater than the cost of the hard money loan.
Not only was it their personal residence that they really wanted, but they had
Their dream home,
50,000.
right.
Yeah, but they also had 50,000 at stake.
So we probably do 1 or 2 of these types of loans per month, where there's a situation where a homeowner needs to close quickly on using borrowed money to do a purchase that for some reason the bank's not going to approve. But the catch is that, generally speaking, they have a way to refinance out of that within 6 to 12 months.
Okay, let me go back to that one example, because I want to make sure that the audience understands that the guy this borrower had a $50,000 non-refundable deposit, but it wasn't a $50,000 down payment on $1 million house. He wasn't putting 5% down. In your case, how much was the loan that you actually lent him?
In that particular case, we actually did do, and this is something we don't do often, but we were able to find a private lender client who agreed to make him an 80% loan. And the reason they made that 80% loan, it was an 80% loan to purchase price, because the loan to value was actually 70% based on the appraised value of the home.
Well, but the developer knew he could sell it for $150,000
right,
more.
the price had gone up $150,000 for the same model home that was now being sold in the rest of the development. So this was a very, very unique situation. Normally, we don't lend more than 70% of the purchase price. Normally, I mean, there's a lot of there's always exceptions, and that's another reason why people come to us, come to private lenders, is because we have flexibility. We're interested in the story. So I want to know what banks used to lend based on the story. Now you're just a set of numbers, and it's either a yes or it's either a green light or a red light. That's it, man. There's no story.
So in this case, this borrower actually did come up with at least $200,000 of real hard cash.
Absolutely.
In this deal.
Right. So he had
for
serious skin in the game.
Yeah, he's generally, barring some, tragedy or something, he's not going to default on that loan, especially since he will get his credit fixed with the bank, and he will cash you out with a regular bank loan in 6 to 12 months or whatever the period is, and go back down to, a 4 or 5% loan rate instead of, what was he, what did you charge him, 8%?
No, that loan, I think we came in at about 9.5%.
9.5%.
And it was because it was 80. If it was a lower percentage, because it was 80%, we had to charge a little bit more than we might have tried to get it for consumer home loans. We try to get the rates down a little bit, but
Sure, but okay, so that your lender, client, investor, he got less than that because you serviced the loan.
right. He's getting on that one. We negotiated a 9% rate to the lender, and then we service it for.
How come you didn't call me on that loan? I would have loved to have funded that loan. Okay.
I'll put your name on the list. And so,
Okay. So again, let's give your phone number and how do people get a hold of you, because we have fairly long segments here and people
right.
waiting.
So our company is Pacific Private Money. We are private money lenders here in Northern California, and we use private individual capital to fund our loans. And our website's pacificprivatemoney.com, all one word, of course, pacificprivatemoney.com. Or call our 415 number. It's 415-883-2150. That's 415-883-2150. And that's a great example. I really enjoy telling that story because we were actually heroes in the eyes of that borrower because they had called a lot of other lenders and were turned down.
Because of the 80%?
Because of the 80%. And also a lot of lenders are just scared of making loans, private lenders I should say. A lot of private money lenders will not make a consumer home loan. They're just, there's a lot of reasons, which all the new laws and regulations that have been passed lately, but we're able to make that loan legally because there are certain exceptions from some of the new Dodd-Frank restrictions on consumer lending.
And was there a minimum guarantee of interest on that?
Yeah, we got a 6-month minimum interest guarantee to our lender. So if he pays it off early in less than 6 months, they have to make up the difference. But we expect that loan will probably be paid off in 9 to 12 months.
Okay. So there's a situation where the borrower would love to pay it off as quickly as possible because he doesn't want to pay you guys, 9.5%. He'd rather pay the bank 4.5% or 5%.
Absolutely.
But you've got a minimum guarantee because your investor client isn't interested in just lending the money out for 3 weeks and getting paid off.
Right, and so that's another feature of private lending is that there's usually a minimum interest period built in. So, and this doesn't apply, of course, if you invest in a mortgage pool fund. If you invest in a mortgage pool fund, it's much like a mutual fund of mortgages.
Okay.
And so you can invest the money in a mortgage pool fund, and your money will be working for you for as long as you keep that money in there until you make a redemption request. But if you fund an individual note or trust deed, you get paid off. You get paid off, and early payoffs are very, very common in the world of private lending when you fund individual notes. Now, the way you mitigate that risk of someone turning around and paying you back in 30 or 60 days and saying, "Thank you very much, but I don't need your money anymore," the way you mitigate that risk is that you write into the note a minimum interest guarantee. And we always try for 6 months, but I will be honest with you, in a very competitive lending environment as we have right now, oftentimes I'm up against other lenders who will offer no prepayment penalty at all. And so I'll try to go, well, how about 4 months? Will you agree to keep the loan at least 4 months? In other words, I'm trying to help my private lender not go through this, in and out, because that doesn't really help them either.
Sure. Well, and here's one of the reasons it sounds like your mortgage pool fund is attractive, because like the example we gave about the babysitter, where you want it and you can't get it. I mean, how many clients do you have who are clamoring for these investments?
Well, here's another example. Let's just talk about a loan request I got today. It's for a 5-unit, fully remodeled, beautifully remodeled 5-unit apartment, small apartment building in the Bay Area. The guy did a gorgeous job, and it's probably going to come in at around $500,000 to $550,000 value of it. He has a master lease on the property for $5,000 per month, $1,000 per unit. Now he only wants to borrow $200,000. So if you do the math quickly, that's less than 50% loan to value. The monthly payments on that are going to be well under $2,000 a month, depending on the final note rate. I'm probably going to offer him a single-digit note rate, something in the 9% range. So in fact, I think we were talking about trying to come in at about 9%, which would be a $1,500 a month interest-only
What
loan
is the
payment
money? Go ahead, I'm sorry.
on a 5,000. And again, the income would be 5,000.
Okay.
His expenses are going to be minimal because it's brand
It's
new.
master
It's
lease.
like new. It's master lease. He's going to be making interest-only payments of $1,500 a month. So here's my point on a loan like that. Do you think I might have a lot of investors who would want that loan?
You know what? I'm kind of sad that you're saying this on the air right now because I'd love to just take that myself.
No kidding. So 200,000. So and I'll tell you right now, I have probably more than 100 private lender investor clients that I could call who would want that loan.
Sure.
Now, my mortgage pool fund gets first look at all the loans. Now, if there's capital in the fund, I will put that loan in the fund first.
Which, in fact, as soon as we get off the air here, where you and I are talking about, I'm going to be taking a good portion of my IRA money, because you said you could take IRA money
Yes,
in your
absolutely.
fund. And I'll start getting 7-8% interest on my money. So go ahead.
But your point being, I mean, the good news about trustee investing and individual note investing is that you can really get some unbelievable rates of return on. The bad news is that because of everybody is, or more and more people are becoming aware of it, there's a lot of competition. So when someone calls me on the phone and says, I'm a new investor and I'd like to consider being put on your trust deed investment or your individual note investment distribution list, I have to be honest with them and say, look, you know, I love new investors and I enjoy talking with you and getting to know, who you are and what your goals are with your investment portfolio. But quite frankly, I have too many individual investors right
Sure.
now, and now that's not to say, and I don't want to tell. I want to infer to the audience that you shouldn't call me, because you should. Again,
Or maybe if they're willing to take 6% interest.
well, there's always. I mean, there's a lot of ways that you can participate in this, and so I don't want to discourage anybody from calling, but there are pros and cons to both sides, to both individual notes and to mortgage pool funds, and I think one of these future shows, maybe next week, we'll talk about. We'll kind of go on down the list and say, here are the pros and cons of investing in individual notes, and here are the pros and cons of investing in a mortgage pool fund.
And also, people can call you at
absolutely, 415-883-2150. I'm happy to run you down. In fact, I just worked on a new blog post over the weekend.
Okay.
It's it intended to be 15 reasons to invest in the Pacific Private Money Fund.
Oh, good.
It ended up being 16. So
and that's Pacific Private Money.
I think, well, I should really delete one so I can have 15 because it sounds better, but it really came up to 16. If I think about it a little bit more, I probably come up with 4 more.
Yeah, exactly.
Reasons.
Yeah.
So.
And that's PacificPrivateMoney.com. You can check out the website there. In this specific case, why did this borrower need $200,000?
So this guy has great credit. He's got money in the bank. He's experienced, but he knows that a bank isn't going to make him that loan because they
master lease.
Well, no. It's not because of that. It's because he just remodeled the property and they want 12 months seasoned income. So in a year, he should be able to get a bank loan, but he wants to pull some of the equity out now to buy other real estate. He's finishing this project. He has no debt on it. It's probably worth $500,000. He's not even looking to pull out the maximum amount that he can, which might be 65 or 70% of the fair market value. He's just saying, hey, I just want to pull out $200,000. It's worth $500,000. I'm going to go buy some other real estate. And
that's a pretty smart
deal. That's a
deal.
very common reason for people borrowing money from an existing property they own, is to take advantage of a buying opportunity now. It's usually not because they're in distress or they need the money or they need to pay for a wedding or college educations. I mean, sometimes that happens, but that's very rare. It's usually for a business purpose.
Well, I remember years ago when we were doing hard money loans that we had a situation where there was a gentleman who owned a shopping center. He owned the land, but not the building. It was a land lease, and he had 30 years to go on the land lease. And he needed money, and there was not a single bank that would lend him money because they didn't bank on land leases. You had to own the actual property. And so what we did was make him a 3-year loan. We figured he's got 30 years to go. That's a pretty safe loan.
Yeah, absolutely.
So same loan to value. In this case, the guy's got master lease, but it's basically the same thing.
So actually today in the office, because we're actually recording this not live. We usually don't say it on the air, but so today in the office midweek, and so I got that loan request, and then I also got another loan request for someone who wants to buy a distressed property in San Francisco and remodel it. Let me just tell you right now that one of the hottest markets for buying a home that's in dire need of remodel
In San
is
Francisco.
San Francisco, because that market is so incredibly hot right now thanks to the tech industry and all of the big tech companies moving in, that housing prices have shot up quite a bit, a little over 20% in the last 12 months. So I have several repeat rehabber clients that will buy an older home. Maybe it's in the Sunset. I mean, there's neighborhoods all over San Francisco where you can buy one of those homes where the ground floor is the garage, and it's usually unimproved space, and there's living space above that.
Okay.
And usually there may be about 1,000 square feet, and so these guys are able to go in there and oftentimes improve the ground level, maybe even add a third floor, and completely remodel these properties. So 70% purchase loan on the property like that, and they come in with all the rehab monies on their own. And again, those are really good loans, and some of the safer loans we make.
Okay, so we're going to have to cut out here pretty soon. So again, for the for the listeners who are thinking about becoming investors in the fund, where they can earn possibly 8% or more, how do they get a hold of you?
Call us at Pacific Private Money, which is 415-883-2150. That's 415-883-2150. Or go to our website. It's all one word, pacificprivatemoney.com. That's pacificprivatemoney.com.
Well, audience, thank you very much for listening to Mortgage Investing 101. We're going to be here next week. And again, check out Mark's website at pacificprivatemoney.com and get ready to earn those high interest rates that are secured by real estate. Tune in next week to Mortgage Investing 101. We're going to be giving away more vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll see you next week.
Ta-da!
That'll generate some good stuff. Yeah. I literally had some a couple calls. A couple calls.
Yeah, I did too. I got a call.
Oh, did you? Good.
And I returned his